Hello everyone and welcome back to the channel, your number one source for income-oriented investing. And this is the first video of 2025. Hope you guys had a good new year, a happy and safe and healthy new year. So today we're going to look at what better way to start 2025 to reflect back on 2024. So I'm going to go through approximately about 10 lessons that I've personally learned in 2024. Some of them are old lessons, some of them are newer lessons, more like reminders. And then I'm going to tell you at the end how I'm thinking of implementing some of these lessons into 2025. So let's get into it. Let's get started right away with the first major lesson that I've learned in 2024. The US stock market is still the undisputed king. No matter what you put the US stock market, the overall US stock market up against, whether it's Canada, whether it's emerging markets, whether it's the whole world, whether it's Europe, whatever it is, it destroyed everybody. It's the best performing economy in the world, best performing stocks in the world, best stock market in the world. And it's just undeniable. It's the undisputed king. And let's actually look at some proof of that. Not only the last year, but the last 10 years as well. All right, so hopefully you guys could see this. I tried to make it as big as possible. So what I've done here is very, very simple. I've actually lined up VOO, which is the Vanguard S&P 500, which is probably the best measure of the overall US stock market, of course. And I compared them to other major indexes. So you have VT, which is the whole world. So VT in Canada would be equivalent to a VEQT or an XEQT. EWC, that's the overall Canadian market. These are all US listed ETFs, by the way. EFA, that's going to be Europe or developed markets outside of North America. So things like Great Britain and France and, most Switzerland, Sweden, things like that. And then you have emerging markets, the last one, the EEM ETF. These are all pretty much in the, popular, basic in low cost index ETF. So if we look at the last year, you could clearly see VOO, the American stock market, just destroying everybody, destroying the entire world, which, by the way, VT, most of it is going to be the US stocks, right? So you see 33.86 versus 26. That's a huge drop down. Versus Canada, about the same at 26.52. And then even worse, Europe, Far East, that includes Australia, Japan, Europe, like I said. And then you have emerging markets in last place. So you've seen the last year, it's not even close, everyone. If you want to go back even in the last 5 years, you see the US is still king. 10 years, the US is still king. So I'm not just talking out of my butt here. The facts are really in the pudding, right? Or I think that's a wrong way to say it, but you know what I'm saying. The facts are the facts, and it's undeniable that the US is still the undisputed king. Next lesson number 2, is that the index style of investing is still king. I mean, in my personal opinion, I think this is the best way to invest in the stock market in general, using indexes. Indexes, in my opinion, are perfect. They beat most actively or stock picking funds. If you just buy the S&P 500, the NASDAQ 100, even if you want to invest in Canada, the TSX 60, most of the index funds are just perfect, right? It's the easiest way to invest. You always ensure you have the best companies because they're automatically rebalanced. They're very low cost, and gone are the days where you just got to get the growth ones. You now have covered call index-based, right, or index-based covered call ETFs, which are doing really, really, really well. And as you know already, because I unveil my portfolio every month, if you want to see that, make sure to subscribe to the channel. That's mostly what I own, right? Index-based covered call ETFs focused on the US stock market because of lesson number 1. The US stock market is king. Lesson number 3 that I learned in 2024 is that fixed income, aka bonds, they just suck, right? Let's be honest here. They're terrible. They've had terrible performance during the whole history of time, I believe. The whole time, right? They've always underperformed equities or stocks. I think that's going to continue. That whole premise of the 60-40 portfolio has not done nothing but hurt investors over the last 10 years. You got 40% of dead money, 60%'s done well, 40% of dead money. My lesson, why bother? Why bother at all as a long-term, even as a long-term growth investor, a long-term income investor, dividend investor, whatever it is? I just feel you are just better off without any fixed income at all. I don't buy the whole premise where you got to have a 60-40 or an 80-20. Why? If anyone could answer the question why, oh, lower volatility, maybe it's safer. It's just a trend, guys. If you're a long-term investor, you should be okay with some volatility to go 100% all S&P 500. If you would just go, would have went in the last 10 years 100% in the S&P 500 instead of a 60-40, you would have been so much better off, and I think you'll be much better off in the future. Of course, now there's a lot of talk about bonds and how they're undervalued and how the rates are going down, blah, blah, blah. I don't buy any of that crap. I got rid of all my fixed income. I will never, ever, ever buy any fixed income ever again. Next lesson that I've learned in 2024 is that split share funds, this is in Canada, specifically in the Canadian side, split share funds can be awesome if you do them right, if you understand them. We see many of them like DGS, DFN, GDV, etc., have all had insane returns, NAV returns of 60, 70% in the last year. That is because of the leverage. So if you understand split share funds, if you don't panic sell them, if you understand everything about them, you know the best time to buy them when they're trading at a discount, when people are panic selling them, and the worst time to sell them, which is during that time, right? You could take advantage of it. If you understand split share funds, they could be a very, very good investment. I would say they're more for advanced investors, right? And they're really, I would say, just like Michelle said, I think she said it perfectly. Split share funds, and I'm talking about Class A shares, specifically, not the preferred shares. Those are boring conservative. I'm talking about the Class A shares. Class A shares or split share funds, they're really growth. They're designed for growth investors with the income investor in mind. Income is a bit secondary, right? So if you understand them, they could be a great vehicle to buy low and sell high later, to just hold over time as well, and to drip them. They have very, very good growth over time, good total return, absolutely amazing total returns, right? Look at the Brompton ones, look at SBC and LBS and GDV, DGS. They all have better total returns than corresponding indexes. So they could be really awesome if you know how to handle them, if you're experienced and you understand them. It's very, very important, because if you don't, it could be big trouble. But that's how other people take advantage, right? Especially when they drop under 15. All of a sudden there's no dividend on the Class A shares. People panic. They forget that that's how they're designed. They sell them off. Then they go at a discount. And then during a market crash, they go really, really low. That's when you buy them. You buy them really, really cheap. And then what happens during a recovery? Check out the returns in the last year. Boom. It's a rocket ship. So they could be really, really awesome if you know what you're doing. Next lesson. The more fund is niche, the more babysitting it needs. This is just my personal opinion, right? If you're buying an overall index fund, the overall market, you don't really need babysitting. It's already diversified. It'll just go up and down with the overall market. But if you're buying sector-specific funds, you're trying to time cyclical sectors, whether it's utilities or REITs right now because you think they're low, or financials, and then they just need more babysitting. And then it goes even further. If you're buying a single stock covered call ETF, you have to babysit it more. So this is just something I would keep in mind, because if you really don't want to babysit anything, just go with index type funds are the best, right, for that. But the more niche the fund is, yes, you could have a bigger reward if you're timing a cyclical sector like utilities and REITs right now, but there's more babysitting involved, there's more heartache, and there could be more volatility as well. Next one is an amazing one. I absolutely love this lesson learned. This was a big surprise for me. Even now, I'm still freaking out over it. Covered call ETFs can beat index funds. They can beat the market. I never thought this was possible. So once again, let's look at some proof. You have in Canada, let's do a few in Canada. You have QQCL, which is the Global X NASDAQ 100 covered call ETF with 25% leverage. And let's put it up against the QQQ of Canada, QQC. QQC is literally QQQ listed in Canada. If we do the total return, you will see that QQCL is still slightly outperforming. Hopefully you could see that it's big enough here for you guys. If you look at the total return, this is of course with dividends reinvested, 53.85 versus 51.66. A covered call ETF is beating an index fund, the QQQ. Absolutely incredible. And I do understand that it has 25% leverage. That is pretty much what's putting it over the top. If we do the S&P 500 one, you're looking at USCL, which is the same thing as QQCL, but the S&P 500 versus VFV, right, which is the Vanguard, probably the most popular S&P 500 one. So this one, if we do since inception, it's very, very close, but it's not beating VFV, 45.89 versus 49.62. But very curious, if we just change the date, instead of putting the inception date, we just do starting in January 1st, 2024 till now. I believe it is very, very close. It is actually beating it. So I don't know why since inception it's not. But if we do just change the start date, you see that USCL's total return with dividends reinvested 41.01 versus 38.72. So here's another example where, well, this one's up to debate. It's beating it since January 1st, 2024, not since inception, but it's very, very close and currently outperforming it if we're taking as of this date. Another example, everyone, is HYLD versus VSP. So we're doing it versus VSP, which is the Vanguard S&P 500 hedged to CAD, because HYLD is hedged to CAD. And you see that if we take the start date of January 1st of this year, and I'm taking this year, not since inception, because as we know, HYLD went through major transformation, and it's not the same HYLD as it was originally. It's much, much better now, and that's all started near the beginning of the year. So if we do HYLD versus VSP starting at the beginning of the year, you see that it's actually outperforming. So these are three index-based, U.S. index-based covered call ETFs that are beating the indexes as of the first of the year. Of course, this is because that 25% leverage has a lot to do with it. But still, I mean, these are literally covered call ETFs with higher fees and higher MERs that are beating the indexes. And then even on the U.S. side, everyone, you have, of course, the XDTEs. I've talked about this quite a bit. XDTE, the Roundhill one. So this is the Roundhill S&P 500 covered call ETF. You see that it is beating VOO, a covered call ETF with a much higher fee than VOO, a much higher MER with no leverage, weekly dividends, gives up some upside, right? I cannot believe it. I don't know how, but it's currently outperforming the S&P 500. And you could see the chart, how just super close it is. And this is maybe another little lesson we could add to the list. Investing in an XDTE or QDTE, look how close it is. It's like investing 99% into VOO or QQQ, right? So a lot of this is, I guess the lesson is you got to look beyond the stock symbol. An investment in XDTE, everyone, is really an investment in the S&P 500. Look at this chart, how close it is. If we do the same thing with the QDTE as well here. So here's QDTE versus QQQ. You see slight outperformance. Look at the graph, how close it is. So remember, an investment in QDTE is really an investment in the NASDAQ 100. You're just getting it with a twist, with weekly dividends, with covered calls, right? So the Roundhill, and even, by the way, the RDT is also beating the Russell Index last I checked a few days ago as well. So absolutely incredible lesson here. Covered call ETFs can actually at least can beat the market slightly, but really in terms of performance versus the index, really, really match up closely to it. Next lesson, everyone. This is more of a reminder. But I've learned this as a lesson. You should try to protect your registered accounts as much as possible. Your TFSA, your RRSP in the States, right? It would be the 401k, the Roth. You got to try to protect these accounts. I don't know how it is in the US, but in Canada, if you have losses, you can't do anything with the losses. So if you want to invest in things that are a little bit more risky, that are a little bit more niche, do it in a non-registered account, do it in a regular account, because you could always offset those losses in the future, especially if you're an income investor. Like I am a covered call income investor, you have a big non-registered. Guess what? Most of your distributions are going to be classified as capital gains. So if you want to go with riskier stuff and it could go bad, it's okay to take those losses because you could always offset with those capital gains. So protect your TFSA, your RRSP, etc. Try to put more, I would say, diversified index-based stuff in there. Of course, it's a little bit more boring, and you're not gonna end up with a $1 million TFSA like Marcus, right? Like the video I talked about. But those are just super success stories. Yes, you could invest in something like a Tesla or Nvidia in your TFSA 5 years ago, and now your TFSA could be who knows how much. But the opposite is also true. You could invest, for example, in maybe cannabis stocks, and then they go down and you absolutely destroy your TFSA room. So try to protect these golden, super important accounts, the TFSA and the RSP. Next lesson is more of a reminder. NAV erosion is still a myth. So I still see people talking about NAV erosion. Seems like, people just don't understand what's going on with that. I've done numerous videos on it. You could even, search. The latest one I did was QDTE. NAV erosion, I still see people say QDTE has NAV erosion. Meanwhile, it's beating QQQ. How does QDTE have NAV erosion if it's beating QQQ? It's impossible. It makes no sense. So this brings me to the next lesson, which is really connected. Total returns, or performance, however you want to call it, total returns, is the ultimate truth. Total return are the ultimate truth. So this is connected to that whole NAV erosion myth, right? So when you're judging a fund, don't look at the management fee, don't look at the stock chart, the stock price, the price return. Look at the total return. Compare it to something it's connected to, right? Like HYLD versus VSP, QDTE versus QQQ. You got to make those connections, right? That's the ultimate truth, and that should be your gauge on how to judge a fund's performance, not the stock chart. Please stop looking at stock charts. Only children do that. Next lesson, and I know many of you have learned this the hard way, crash predictions, recession predictions, all that crap is still 100% useless. Where's the market crash of 2024? I thought there was going to be a recession, there was going to be a correction, blah, 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 blah. It's all nonsense. If you haven't figured out that it's complete nonsense and a waste of time thinking about this, unfortunately, a lot of people went to cash, waiting it out, waiting for the market to correct. It never came, and you missed out on such a lot, huge gains, right? So crash predictions, market crashes and recessions and corrections, of course, they're always going to happen. But forget about trying to predict them, everyone. Stick to the plan. Keep buying. Keep investing regularly over time. That's the golden rule of investing. You're not a speculator. You're an investor. You're not trying to get in and get out and try to time the market. You'll lose more than you'll gain. Trust me, even the professionals can do it. Last lesson. This is more for me, general, overall. I don't know if it's a lesson or not, but I'm going to really, in 2025, call it a New Year's resolution, if you will, I'm going to really embrace the kind of investor I am. So the lesson is embrace the kind of investor you are. I am an income first, an income focused investor. I'm not going to shy away from volatility anymore. Volatility is my friend. Also, and if we take all these lessons, including this one, I'll give you a little preview of maybe how I'm going to incorporate these lessons now in 2025. So I'm not going to shy away from volatility, because volatility is really what's great if you're investing in covered call ETFs. You have higher premiums. I'm a long-term buy and hold investor, so I'm not going to shy away from volatility. So I'm very excited about this Harvest all-in-one single stock covered call ETF coming out, which is going to have MicroStrategy and Coinbase and Tesla and Meta, Palantir. Most of them are going to have 25% leverage. It's going to be very, very high yield, guys. Probably over 20% yield. I'm very excited about it. So I'm going to probably have a massive position in there. I'm also going to seriously look at my holdings and look at especially the non-US ones. So, HYLD, QQCL, USCL, those are my three musketeers. But there's other funds that are either Canadian focused or like GDV have the entire world. So I'm really going to take a look and think about, do I really need this? Like we saw in the first lesson, everything underperforms the US. Plus, I'm an income investor, cover calls. That's where the options markets are the best. So not only does the US have the best performance, the best equities, the best stocks, they have the best options market, the biggest options market. It's the best stock market in the world, best economy in the world. I'm not going to shy away from that. So I do expect some major changes, really, even at the beginning of the year. And I'll probably make a video for members really detailing, I think, my plans for January, February of 2025. So if you're interested, if you want to know what my plans are exactly in detail, hit that little join button in case you're not a member. You'll get access to that video when it comes out. Another thing I'm incorporating, by the way, I talked about this already. I'm never buying fixed income again. I don't care. With the covered calls, right now there's a lot of fixed income covered call ETFs. I'm staying away from that. Why would you bother with that when you could just invest in equities instead? And again, lesson learned, they might have really, really high yield, good yields, but look at the performance. Look at the performance versus the S&P 500. You'll see that it's not even close. And again, I'm going to embrace volatility as well. So those are really the lessons that I think I've learned. Some of them are, more reminders in 2024. Let me know what lessons you learned in 2024. Were you maybe waiting for a crash that never came and you learned that lesson because your cash did nothing and you missed out on all that, all those gains? So that could be an important lesson. Let me know what you think. Let me know your comments or questions, suggestions. And I really appreciate your support, guys. Hit that like button. I would really appreciate it. And we're going to have a fantastic 2025. I think the market during this Trump administration, especially the US markets, are going to be great. We'll see what happens. I'm not predicting anything. Hopefully there's going to be a big political change in Canada as well that could help the Canadian markets as well. But, even if Trudeau's out of there, I honestly think, like we saw the first lesson, the US is always going to beat Canada no matter what. I think it's just the best economy in the world. So why fight it? So thanks for watching, guys, and see you next time.